Okay, good morning, everyone. So let me start by thanking the organizers for putting together such a nice program. And let me also extend my thanks to Bank Al-Maghrib for sponsoring and hosting the event. They did an amazing job. So now it is my pleasure to introduce our plenary speaker for this morning's plenary session, Professor Dani Rodrik. So Professor Dani Rodrik is the Ford Foundation Professor for International Political Economy at the Kennedy School of Government at Harvard University. He previously held positions also at the Institute for Advanced Study at Columbia University. He is currently the co-director of the Network Economics for Inclusive Prosperity and the president-elect of the International Economic Association. Professor Rodrik has worked on a variety of different topics, but he's best known for his work on globalization, political economy, and growth. He is a very prolific researcher who produced more than 150 articles and published several books, the newest of which is Straight Talk on Trade, which tackles important questions related to globalization, or I should say hyperglobalization, and which I strongly encourage you to read. So I now invite Professor Rodrik to the podium. So you'll have 60 minutes, after which we'll open the floor to questions from the audience.
Thank you very much, Afid, for the introduction, and I want to thank the Econometric Society and Bank Al-Maghrib for the invitation. It's very nice to be here. I'm going to be talking about growth miracles and why I think we've come to an end with growth miracles. I will give you a more specific definition of a growth miracle later on, but let me begin by pointing out that in a way it's incongruous to talk about the end of growth miracles coming off as we are from a period when in fact low and middle income countries have done really well in terms of economic growth. If we go back to the immediate post-war period and look at the experience with economic growth dividing the world into a developed and developing part, you can see that the developing countries as a group began to overtake the rich countries from the 1990s onward in terms of their overall growth performance. So this chart essentially shows of a smoothed annual growth rates of these two groups of countries, developed and developing. The first thing to notice about this chart is that up until the 1990s, in fact, the advanced countries, the rich countries, were growing more rapidly than the developing countries. And this is, of course, the opposite of what you would expect from standard convergence theory, which I'll come back to a little bit later, which would suggest that developing countries should find it easier to grow and they should be growing more rapidly. But after the 1990s, in fact, we have not just the developing world beginning to increase their growth rates, and doing so, in fact, increasingly more rapidly. Now, a lot of that a ramping up of the growth rate in the developing world, the orange or red curve, depending on your degree of color blindness, is a lot of that is really China. As China becomes a bigger and bigger part of the developing region, it tends to push up the growth rate of the developing world. But it is also more than China, as I'll come back to. Of course, includes East Asia, and also includes many countries in sub-Saharan Africa and some in Latin America as well that have been not only growing very rapidly, they've been growing more rapidly than they ever did in the post-war period. The other thing that you will notice from that chart is a kind of a somewhat pointing down at the end. The curve begins to turn south in the last few years. That's just a few years, and it's not necessarily very strong evidence that the growth boom for the developing world is over, but it is suggestive, and I'll come back to that. So I mentioned different parts of the developing world. So if you divide up the developing world into three different regions, Asia, excluding Japan, Latin America, and Africa. So this is the picture that you would see. Of course, you won't be surprised to see that the part of the developing world that has done the best is Asia. But even in the case of Africa and Latin America, you can see that their recent growth actually has exceeded the early growth boom that they had in the immediate post-war period. So what do I mean by growth miracle? I have something specific in mind. I mean, obviously, a very rapid growth that has been maintained for some period of time. Here, the standard that I've used is a growth rate of 4.5% or higher in per capita GDP terms that's maintained for at least a period of 2 decades. So sort of a medium-term growth rate of 4.5% or higher. And we typically associate growth miracles with East Asia, but this table shows that in fact it's not limited to East Asia. In fact, I think the first wave of growth miracle countries are actually those that were in the immediate periphery of Western Europe in the post-war period. Here, Italy and Spain are the two examples of that. You can see that in the immediate post-war period, their growth rates were 4.6% and 6.1% annually. For those of you who've been following Italy recently, to think of Italy growing at more than 6% is a little bit of a shock. But yes, that's what they did. Italy experienced very rapid growth in the after post-war. Then you have, of course, the East Asian countries. Japan is well known, so is South Korea, Taiwan, China at the very end. But we also have a few non-Asian and non-European countries as well. The country that I've included here, which I like to add, is because it's probably the sole exception of a growth miracle in Africa is the case of Mauritius, which grew at a rate of 4.6% per annum for more than 2 decades after independence, after 1971. Just by comparison, of course, the long-term growth rate of the U.S. economy has been about 2% per capita, and the behavior, the performance of low-income countries as a whole has been much, much worse, something less than 1% per head over the long term. So these growth miracles are special. It's higher than really anything. If you go if you go before the Second World War period, you really can't find any of these except for maybe a couple of just sort of resource boom countries. Other than that, seems to be fundamentally a post-war phenomenon, and a phenomenon that's been limited to a few countries that have in turn served as models for others, which is why understanding where these growth miracles come from is, I think, so important. Now, I mentioned the recent growth, and that this recent growth has been relatively broad-based. Here's a table with some of those countries that have done well. And here, in fact, sub-Saharan Africa is well represented. Ethiopia is a very interesting example for a country that for a long time did very poorly, is one of the world's poorest countries. But really, since 2000, has been growing very, very rapidly. In fact, the average growth rate is almost 8% per head since 2000. And Ethiopia is interesting because it is not a natural resource-based country. And so this is not an experience based on a resource boom or natural resource discovery. There are other African countries that have done well. Rwanda has done well. You probably are familiar with that, although it's not included in this table. Of course, we have India, the second country pointed out with an arrow, that has had a growth acceleration since the early 1980s and has been growing very rapidly. Recently, there has been some question about the growth numbers for the last few years. In Latin America, Peru is a country that has done extremely well, with a growth rate above 4% per head since the 2000s. But in general, Latin American countries have been doing much better after the late 90s, early 2000s. So I'll come back to that, to sort of, to this at the very end of my talk for these countries, because it seems to me that even though this very recent growth experience is encouraging, and there are certainly lessons to there, I'm going to suggest that these recent wave of growth expansions, or growth spurts, I'll call them, as opposed to growth miracles, derive from a very different kind of channel. And I think, and that channel really puts into question the sustainability of these most recent growth spurts. But first, I have to tell you where growth miracles really come from. So I'm going to emphasize, when I talk about growth miracles, about a particular channel that I think is a very strong, very pronounced, a powerful escalator for growth, and that's the role of manufacturing industry. So I will identify rapid industrialization as the key channel, key element of growth miracles. Then I'll come to the sort of the pessimistic part of my message and talk about a process that I've called premature deindustrialization. That is that, in fact, in recent decades, in fact, over time, it has become harder and harder for countries to experience rapid deindustrialization. The countries are deindustrializing at much lower levels of income, much more rapidly, at much lower levels of industry than before, which is my fundamental argument as to why growth miracles are going to be a thing of the past. This process of premature deindustrialization is really acting as a brake for long-term sustainable high economic growth. Then I'll talk a little bit about sort of if manufacturing, the traditional convergence escalator, is not going to be there, are there alternative paths? And in turn, how can we interpret these recent wave of growth spurts if industrialization has not been behind their experience, as indeed it has not? Okay, so that's sort of that's the outline. So how would we explain growth miracles of the type that I briefly talked about, the East Asian and a few Southern European and a few other examples? The traditional theory would have difficulty explaining growth miracles. Sort of the first theory that you might rely on is the standard convergence framework, which says that, well, of course, developing countries should grow more rapidly than developed countries because they have access to technology, they have access to capital, they have access to global markets. And the poorer they are, the more rapidly they should converge. And that the fact that very poor countries are growing very rapidly should not be necessarily a puzzle, except that, of course, there's no data, there's no evidence in the data of what's called unconditional convergence. That is, that's simply asking the question, do poor countries grow more rapidly? The answer to that is no. I'll show you a picture in a second. So the standard convergence story doesn't really explain. What about conditional convergence? The conditional convergence is the argument that, okay, convergence does work, but only when you do the right things. So it's conditional on having the right institutions and the right policies. I'm going to argue that that, in fact, also is not a story that fits very well. For one thing, it's even conditional convergence is too slow to account for rapid growth. What about good policies, institutions, or perhaps just luck? And there, again, I don't think that there is a good explanation because these miracle countries were in fact not typically blessed by good initial conditions. There were, when East Asian countries, like South Korea in particular, was a basket case in the late 1950s, which was a source of concern in the aftermath of the Korean War for the United States. So there was a lot of social science done in the second half of the 1950s in the US trying to explain why South Korea, in fact, was unable to grow rapidly. And that all of that sort of, became rather extraordinary in terms of how social science can go wrong once the South Korean miracle took off in the early 60s. So let me talk a little bit more about each one of these, not a whole lot. One on sort of the standard the convergence story. Do poor countries grow more rapidly than rich countries? And the answer to that is, if you look at either sort of long-term or even short-term, there's really no evidence for unconditional convergence, except possibly for the last couple of decades, which I've shown you. Developing countries have done better as a group. But even there, sort of the rate of convergence, when you look at, is it the case that necessarily poorer countries are doing better than countries a little bit less poor than them? The evidence on that is actually quite weak. These charts show you that essentially the relationship between initial levels of income and subsequent growth rates is flat, which if there was convergence or unconditional convergence, what you would expect is a very strong negative slope, which is that countries that start with very low levels of income would be growing very rapidly subsequently. In fact, there's no such general evidence. So that convergence coefficient there in that equation, gamma, is essentially nearly zero. What about conditional convergence? The conditional convergence would sort of say that this long-term income level to which you converge, that Y star in that equation, is conditional upon your policies and institutions. So there's a vector, theta j, of your policies and institutions that condition your long-run level of income to which you will converge. So you converge only if you follow the right kinds of policies. The problem is that even though there is evidence in the cross-country growth literature of conditional convergence in this sense, which is to say if you control for quality of institutions, you control for educational and human capital, and a few other things. Indeed, then controlling for those things, poorer countries tend to grow more rapidly. But the fact is that the estimated rate of conditional convergence is still very slow. The typical convergence parameter, the gamma, is around 2% per annum, which means that you're closing every year only 2% of the gap between your long-run income level and your current level. And that's going to produce growth rates under various reform scenarios that even under a very strong reform program, where every year your potential income, your long-run income rises to eliminate about 1/3 of the gap with rich country income, then you're going to get, and that's a incredibly strong reform program by the evidence of anything that we have around the world, that the kind of growth rates you're going to get would be, and that's sort of the red curve there, it's about 2.5% per annum. So it's not really giving you a growth miracle. It's going to give you a solid, sort of long-run U.S. level kind of a growth rate. Besides, the conditional convergence framework assumes that we actually know what those good policies and good institutions are. So in the previous chart, I just said, okay, suppose that you pursue a reform policy that is raising your long-run income, but that means you have actually a pretty good handle on what those policies and institutional reforms are. The fact is that we actually don't have such a good handle on what those institutional reforms and policy reforms are. One way to see that is to actually check what it is that the growth miracle countries did and to what extent it corresponds with our understanding, or sort of the Western, or let's say the Washington consensus understanding of what good policies and institutional reforms in fact are. If we look at sort of all these different domains of institutional and policy reform, everything from property rights to public finance to labor markets to trade to state ownership, the kinds of things that happened in East Asia, whether it's Japan, whether it's South Korea, whether it's Taiwan, in terms of the things that they did at the time of their growth miracles, really is a very bad fit with our notion that the way to get growth, rapid growth, is to privatize your state enterprises, to open up to trade, to deregulate goods and labor markets. So at once I did a kind of a grading, a score sheet for these countries as to sort of, how would, if you looked at their policies during the growth miracle, as to how well it fit the famous 10 items on the Washington consensus list. And then I think Korea was about a 4.5. That is that in some respects, such as macroeconomic stability and maintaining a competitive currency, it was certainly did those things. But in many other domains, including the extent of trade restrictions, the extent to which there was industrial policies and government intervention in the economy, it certainly did not do. I think Taiwan was a little bit better, more like 5 and 5.5. But the point is that these countries really don't fit very nicely into our preconceived notions about what good policies and what good reforms are. So where is these growth miracles coming from? I'm not going to say a whole lot about the specific policies. I'll just have one quick slide on that. But I want to emphasize instead the mechanism. I think the mechanism in all of these growth miracle countries is very rapid industrialization. So if you look at the share of manufacturing in total GDP, or you look at the share of manufacturing employment in total employment, what these countries all have done is experience very, very rapid industrialization. On the left panel, you have Italy and Spain, the two European countries I mentioned too. On the right panel, you have the Asian countries, which in the case of the Asian countries, you will see two things. One is a kind of a scattered pattern or a sort of different phases for different countries. So the country that has the first wave is Japan, is followed by South Korea and Taiwan, and Malaysia, the country in orange, is the latest to achieve rapid industrialization. The other thing you notice there is then a period after which sort of the reverse U-curve kicks in. That is, you begin to have a deindustrialization process after a certain point. And that's historically very common, that countries first industrialize and then deindustrialize. I'll come back to that. What's special in these countries is not only just the very rapid industrialization, but the very rapid deindustrialization as well once they've reached sort of their peak levels of industrialization. But they did have this rapid industrialization in the 60s and 70s into the 80s. China, of course, is another case of rapid industrialization. Now, it's not just that these countries experience industrialization very rapidly. It's also that when you compare these countries to non-miracle cases, that is that these countries look dissimilar in that at every level of income, they tend to have much greater shares of manufacturing industries in output and employment. So if you draw these U-curves or inverse U-curves that relate manufacturing, in this case, manufacturing output, MVA, I'll show you the picture for employment later, and you compare the miracle to non-miracle countries, the miracle countries is the red curve, and the non-miracle cases is the blue one. You can see that these countries basically experience much higher levels of industrialization at every level of income. So they're structurally different. It's not that it's not that they're experiencing the same developmental transformation path, except that they're going through it much quicker. It's just that they're actually they're over-industrializing relative to their levels of income compared to other countries. And this is pretty similar with respect to employment as well. And you can see the red curves on top of the blue one for the share of employment in total GDP. Now, so if this is really what stands out in the experience of the growth miracles, the role of rapid industrialization, the next natural question is to ask, why is manufacturing such a powerful, potent growth escalator? Or why is manufacturing so special? I think there are three reasons for that that I want to emphasize. And all three reasons are critical. So when later on I asked the question, well, if manufacturing is no longer going to act as a kind of escalator as it has in the past, are there other sectors, for example, can services take their place? We need to go back to these reasons and ask, can services play the same roles in the way that manufacturing traditionally did? So the number one critical feature of why manufacturing is special has to do with productivity dynamics. That is that manufacturing, unlike the economy as a whole, exhibits unconditional convergence. In fact, relatively rapid unconditional convergence. Remember what I said before, that when you look at developing countries, there is no unconditional convergence. Poorer countries don't grow more rapidly. But if you look at manufacturing, in particular formal manufacturing in the poor countries, in fact, you find out that there is unconditional convergence within that sector. That is, if you get on the escalator, if you start out producing manufacturing in a poor country, regardless of your policies and institutions, the poorer you are, or the lower the labor productivity in that manufacturing, the more rapid subsequent productivity catch-up. So here's the pictures that go with that. Remember that I told you that in these convergence charts, what you would be looking for would be a very sharp negative slope, that the lower the initial incomes, or in this case, these are manufacturing, two-digit subsectors in the left-hand chart and aggregate manufacturing in the right-hand chart. That the lower levels is basically lower labor productivity to start out with, and the vertical axis is subsequent growth in labor productivity. And lo and behold, in manufacturing per se, you have this very rapid process of unconditional convergence. So a country like Ethiopia, no matter its geography, no matter its connections to the rest of the world, no matter its policy environment, its institutional environment, when it gets on this escalator, when it starts developing some formal manufacturing, the formal manufacturing sector, in fact, is expectationally going to experience very rapid productivity growth, much more rapid productivity growth than in countries richer than that. And furthermore, this convergence coefficient is relatively high at 3. It's 3%, which, remember, for the economy-wide, even conditional convergence coefficient was about 2%. Now, that doesn't mean that having good policies, good institutions, whatever those might be, won't increase your productivity growth rate even more. All that it means is that even without the benefit of those complements, that manufacturing is a powerful escalator for productivity convergence. So this productivity dynamics, the fact that you have unconditional convergence in manufacturing is a key fact. Now, why might that be so? Well, maybe there is a kind of something to do with the technology of manufacturing that is easier to copy. That when you're producing bicycles or you build a car plant in a developing country, you basically are copying what other countries have done. And even though you're going to start with a productivity penalty, then you're basically catching up and just basically copying and producing that technology seems to be much easier than in other domains of economic activity. Somehow there's organizationally this technological transfer and convergence seems to be easy. Now, the second feature, which I think is also very important, is that it's not just that manufacturing is this escalator. It's also that it's an escalator that can accommodate the resource that developing countries are the most abundant in, which is low-skilled labor. Because traditionally, manufacturing, standardized manufacturing in particular, has been relatively low-skill intensive. So you could take farmers and peasants from the countryside and turn them into production workers in manufacturing without having to invest in a lot of skills and training. So the fact that manufacturing traditionally has had a very large labor absorption capacity means that on the supply side, manufacturing is not constrained. There are no constraints on the expansion of manufacturing on the supply side because the key input on unskilled labor is available in a very plentiful fashion. Now, this is one thing that I'll come back to because it's one of the key things that has changed in manufacturing, which is that manufacturing has become much, much more skill intensive and therefore is now much more constrained on the supply side than it has traditionally been. Finally, it's not just that there are no constraints on the supply side, that there are also very few constraints on the demand side, which is that imagine the manufacturing as an island in a low-income country that is experiencing this rapid productivity growth and is not constrained on the supply side. If the output, if the supply of manufacturing could not be sold on world markets, what would happen was that manufacturing's domestic terms of trade would eventually turn against itself because you're growing very rapidly, but you can serve only the domestic market, and therefore, in the domestic market, incomes aren't increasing as rapidly as productivity in manufacturing is increasing, and therefore, the only way you can increase supply is by having to sell at a lower and lower price relative to, let's say, the GDP deflator. So manufacturing would experience a very rapid decline in relative prices, which in turn would act as a brake on manufacturing investment and profitability. Whereas, in fact, the fact that manufacturing is tradable means that you don't have any constraints on the demand side either. That is that you can, for a low-income Ethiopia, in principle, can sell on world markets and is not constrained. The demand for Ethiopian manufacturers is not constrained by the productivity of other economic activities in Ethiopia. It's only constrained by the global demand for manufacturing, which, of course, as far as Ethiopia is concerned, is essentially infinite. So you put those three things together, you can understand why manufacturing is such a powerful escalator, that it has its own endogenous convergence dynamics. It can expand very rapidly by drawing on the resource that developing countries are the most well endowed in, and doesn't really face, until the country gets rich and gets sufficiently large, doesn't face a constraint on the demand side either. Yeah? So if we put these things together and think about how sort of the traditional convergence story changes when we allow the fact that manufacturing is different from the rest of the economy, the most economical way of doing this is simply to consider a kind of a two-sector model where the convergence properties of the manufacturing and the non-manufacturing sectors are different. So look about that equation. The convergence equation now has the growth equation now has three terms. The first term, A, is the standard convergence part. That's for the economy, your basic growth of the overall labor productivity depends on your fundamentals, on how rapidly your long-term growth rate is changing. So A is the standard conditional convergence term. B is now the new term that is the convergence that comes out of manufacturing. And that's sort of now that's not conditional because the long-term productivity, the relevant productivity frontier for manufacturing, Y star M, is going to be the productivity level in the advanced countries. And as that term shows, there's automatic convergence there, with beta, the convergence being perhaps as high as 3%. However, the contribution that manufacturing can make to aggregate growth is limited, especially in the early periods, by the low share of manufacturing employment in the economy as a whole. So that alpha parameter is the size of manufacturing in the economy as a whole. And it turns out as a quantitative matter, even if you have very rapid convergence in manufacturing, manufacturing is not going to give a very big kick for economy-wide growth as long as manufacturing starts out being a very small part of the economy. So typically, formal manufacturing in a very low-income country is not going to be more than 3 or 5% of GDP or employment. And therefore, quantitatively, the kick you get from there is very limited, actually. So where does actually industrialization play a big role is in term 3. In 3, this C term is the structural change term. That is that as long as we have this productivity gap, remember that you have the manufacturing sector on this productivity convergence escalator. So productivity, labor productivity in manufacturing, pi m, is going to be higher than productivity in the rest of the economy. Let's call it the traditional part of the economy, pi t. So pi m minus pi t is large as long as you're moving labor out of the traditional sector into manufacturing. This structural change term, C, is going to be really where the kick in terms of the contribution to growth is really coming from. And if you just simply do very simple numerical simulations, that's exactly as I've just described it. So a country that's going to, this is now drawn for a country that I assume is experiencing rapid industrialization. So D alpha is relatively large, rapid industrialization. So the share of employment in manufacturing increases by around 1% as a share of total labor force per year. This is not that different from the experience of some of the East Asian miracles. And then if you look at the total growth rate and then its 3 subcomponents, terms A, B, and C, you can see that first you're getting very rapid growth rates. So you can generate the kind of growth miracle that I was talking about before. Growth starts out at nearly 8% per capita early on. This is a country that's starting at, I think, 10% of the frontier income level. Of course, that's coming down as convergence takes place and the distance with the frontier closes down. But you can look at the contributions, the other 3 curves. You can see that the bulk of the contribution early on is really coming from the structural change term, which on its own early on contributes between 4 and 3% of growth on its own. And that what's happening in manufacturing itself isn't necessarily productivity convergence in manufacturing itself doesn't directly play a role until much later on, and that's simply a result of the artifact that the manufacturing sector is small to begin with. So the rapid industrialization is the key because it pushes people from where the low productivity occupations to higher productivity occupations. Productivity convergence within manufacturing is important because that's what drives that productivity differential in the first place. Okay? So that's why I think this mechanism is so powerful and makes sense. Now, I said that I wasn't going to talk much about policy, but the next natural question would have been sort of what are the policies that actually produce rapid industrialization? And this is sort of my one slide answer to that, and I'm happy to answer questions about that in the Q&A. But essentially, I would identify three key factors. One, what I call sort of the macro fundamentals. Reasonably stable fiscal monetary policies, reasonably business-friendly policy regimes, so with emphasis on reasonably, which is to say that you cannot rely that necessarily that every time you're moving a couple of ranks up the World Economic Forum's competitiveness index or the World Bank's ease of doing business index, that necessarily that's going to reliably generate more growth. The second part that I've stressed in my own work, which differs from the sort of the standard Washington consensus type agenda, are what I've called pragmatic, opportunistic, and often unorthodox government policies that directly try to stimulate domestic manufacturing industries. I've already mentioned how growth miracles like South Korea, Taiwan, and certainly China pursued policies that differ from the standard sort of the macro fundamentals agenda. And here, every country has done things that are somewhat different. So South Korea and Taiwan have heavily subsidized their manufacturing industries, particularly exports, but the subsidies have been taken different forms. So in Taiwan, it's been tax incentives. In Korea, it's been credit subsidies. China has done it with a mix of other policies, including kind of a dual track, special economic zones, and a wide range of industrial policies, which of course now are at the root of US-China trade tensions. Mauritius, which I mentioned before, the growth miracle there is largely the result of the Mauritian version of the two-track Chinese approach, which in their case was the setting up two different policy regimes. One regime for investors that wanted to export abroad, another regime for investors that operated for the home market, and they had very different trade and investment policy regimes for those two parts of the economy. And then the third, the contribution of the global context, and this was largely a period of benign neglect, I would say, from the part of the advanced countries, and that they maintained reasonably open market access. Although certainly in the case of countries like Japan, South Korea, and Taiwan, which experienced their growth booms earlier than the more recent examples, it wasn't free trade by any means, and their exports were in fact, the trade barriers that they experienced at the time in the 50s, 60s, and 70s were much higher than anything that more recent countries have had. So again, it's sort of moderate and reasonable access to markets abroad rather than necessarily free trade is what seems to have played an enabling role. Again, I'm not going to say much more about the policies we can come back to. So this is all a nice story if we can continue with it. And the question is why I think these growth miracles have come to an end or are coming to an end. And I think the key idea here is premature deindustrialization, which I've written about in a number of different places. There are changes both in the global context and in the technological context that lie behind premature deindustrialization. So there are three roughly in order of importance, I think, that I've mentioned here. One is just the process of technological change that has made manufacturing more and more skill intensive. What that means is that one of these great advantages that manufacturing had, which was its labor absorption capacity, manufacturing is now becoming less and less adapted to the underlying comparative advantage of low-income countries. So in the limit, if you can produce garments and shoes with 3D printing, then it becomes cheaper to produce these traditionally labor-intensive commodities in the United States and Germany than it would to do so in Bangladesh or in Ethiopia. And we haven't gotten there yet, but that's the process that has been now taking on for a long time. You can sort of see the skill upgrading of manufacturing and the increasing divergence of the skill requirements, the technological requirements of manufacturing and the skill and technological endowments of the developing countries. And that divergence means that manufacturing is able to act less and less like a growth escalator. The second role is globalization. It makes a difference that a number of countries developed very strong manufacturing bases before you did, and now you have to compete with them. And the traditional natural kinds of mechanisms of infant industry growth or infant industry development that countries earlier had access to are no longer available to the newest crop of convergent countries. So what that means in particular is that when you were a 60s and the 70s, a developing country, even if you had a fairly permissive trade regime, there was enough natural protection in the system that your domestic entrepreneurs who were started to produce some very basic, simple manufactures, toys, bicycles, chairs and tables, basic furniture. They had enough natural protection that they could develop some local capabilities in manufacturing. And not all of them became eventually successful and productive, but enough of them did that often later manufacturing successes were built on these early possibilities for developing some learning and training. What's happening today, if you look at, again, a country like Ethiopia today, is that it's completely different. That nascent manufacturing in Ethiopia has no chance to compete against imports from China or imports from East and Southeast Asia. So the simplest things like table chairs, cardboard boxes are being imported. And because it's just cheaper and easier to import. So that you don't have that natural protection. And I think this is something that's, if you believe that there are learning effects and learning externalities, this is something that's undercutting industrialization opportunities. And finally, there is a sort of a long-term secular shifts in the demand in global economy away from goods into services. That means that there's a long-term secular decline in demand for manufacturing and into services. That means that everything else being the same, actually the global market for manufacturers is shrinking. This is, by the way, the strongest reason why there's a trend towards deglobalization in the world economy today. It's not because of protectionism, it's because services are becoming the more predominant part of economies, and services for the most part are less tradable than manufacturing and goods, okay? So let me just show you just a couple of pictures on the extent of this process of premature deindustrialization, because it's important to underscore how quantitatively significant it is. So these charts show you basically estimated coefficients for each decade, going all the way between 1960s and the most current period. From a regression where I regress manufacturing shares in output, or in this case, employment, on the usual determinants of sort of the standard explanations across countries and over time of what determines the share of manufacturing in a country. That tends to be income, that tends to be demography, so this has also fixed effect for countries, as well as dummies for different periods. And what you see, if you look at the left-hand chart, is the rather dramatic decline in manufacturing employment shares across countries over this period. That is that by the time you come to the 2000s, your typical country has a share of manufacturing employment in GDP that's 12 percentage points lower than what it would have been expected on the basis of its structural characteristics compared to the entire post-war period benchmark. Right? So very huge decline. If you, on the right-hand side, focuses only on those countries that have a strong comparative advantage in manufacturing. And you see that in terms of employment deindustrialization, that even those countries are experiencing strong employment deindustrialization, even though in those countries, so this is a handful of East Asian and other countries with strong comparative advantage in manufacturing, even though the employment deindustrialization in those countries isn't as large, but still is quite significant. This is the same picture, but focusing on manufacturing output, manufacturing value added as a share of GDP. With respect to the bulk of the countries, it's a very similar kind of a secular downward decline in the share of manufacturing in GDP. The only difference is with respect to the strong manufacturing exporters. You can see that trend is sort of flat and not different from zero. So the only countries that have managed to avoid deindustrialization, and now all countries eventually deindustrialize. What you have to understand here, this is deindustrialization relative to how much industry you would be expected to have, taking into account your population and income as well. So it's already taking into account the kind of natural deindustrialization, maybe I should say extra deindustrialization. The only countries that have managed to avoid extra deindustrialization are the countries with a strong base of manufacturing exports, and these relatively small number of developing countries. And even then, they've avoided them only for output and not for employment, where the employment effects are still very strong there as well. And that's obviously has to do with the increasing skill intensity of manufacturing that is becoming less and less employment intensive. So here is the sort of the picture for premature deindustrialization. If there's one picture that captures it, it would be this. So this is for a bunch of countries. It shows on the horizontal axis the income level at which manufacturing employment has peaked. And on the vertical axis, it shows the level at which manufacturing employment is when it peaks. Okay? So the fact that this curve is a very strongly negative or positively sloped shows you that there was a bunch of advanced countries where deindustrialization set in relatively late and set in at a time when, in fact, manufacturing was already pretty high. So if you look at countries like Sweden, Germany, the UK, the United States, manufacturing employment typically reached levels of 30-35% before it began to come down. And that was relatively at sort of high levels of incomes. By the time you even come to Korea, Korea never went beyond about, I think it was 28% in terms of manufacturing employment, and it began to deindustrialize much earlier. You come to African countries, other Asian countries like India, or certainly Latin American countries, much sooner deindustrialization and at much lower levels of income. Okay. So what we're experiencing, therefore, now today, we have a very different pattern of structural change that's happening in the developing world compared to what is the case traditionally and in history. So this is the traditional pattern of structural change during the process of economic growth, modern economic growth. You start with all your resources and labor in the informal agriculture, then industrialization sets in. Labor moves towards your manufacturing sectors and your organized formal sectors. Then ultimately, there's a process of deindustrialization where labor moves into services. Today, the process looks like this for most low and middle income countries. It's not as if people aren't leaving agriculture. People are still leaving the countryside. There's still urbanization that's taking place. But people who are leaving the countryside are no longer finding jobs in formal, organized manufacturing. For the most part, they're going into petty services, informal services, where productivity levels are not that much higher than in the countryside in traditional agriculture. So this channel of strong push for growth that you got from my sort of two-sector stylized framework, that strong process of structural change is not stimulating growth. So, can services be an alternative? For the most part, no. Services in the developing countries come essentially in two forms. You do have some high productivity tradable segments of services. The trouble with those is, the trouble with manufacturing today multiplied by a factor of 2 or 3, which is that they're very high productivity, they're very skill intensive. So you see this problem, particularly, for example, in India. India is a case where IT and other business services have expanded very rapidly, but they really have not had a quantitatively significant impact on economic growth, simply because the vast majority of the labor force has no chance of being employed in those sectors. So they are condemned to remain as enclaves and very small sectors. The bulk of services are, in fact, these low productivity and for the most part non-tradable services, and these cannot act as growth poles, and for the reasons that I've already mentioned before, which is that even if you're able to identify certain subsectors, let's say retail trade, that you can give a major productivity boost, let's say by bringing in French or US hypermarkets into your country, they are constrained by the demand for their services, which is they're constrained by productivity in the rest of the economy. So they cannot act like growth poles or growth escalators in the way that a tradable sector like manufacturing traditionally has done. Well, what about agriculture? I think there are significant productivity gains that are possible in traditional agriculture. In fact, probably a key reason for Ethiopia's very rapid growth in the recent decade or so has been rapid productivity growth of traditional agriculture. But the trouble is that it's very difficult to imagine a scenario when agriculture will continue to absorb employment. In fact, historically, agriculture has always lost employment. So the question, the puzzle that this story poses is the absence of any sector that can simultaneously experience very rapid productivity growth and absorb employment at the same time. Okay? And even if agriculture is going to experience very rapid productivity growth, it's very difficult to envisage as a sector that's going to also absorb employment at the same time. Okay, let me conclude by just saying a couple of words about going back to these recent growth spurts, because I've given you a story that sort of says, well, we should not be having growth rates of the type that Ethiopia has been achieving in the last decade or half. So where is this growth coming from? And whether you look at Ethiopia or look at Rwanda or you look at India, these are not cases where growth has been driven by industrialization. Okay? So the pattern of structural change in these recent growth spurts is very different. In Ethiopia, for example, that often makes the news for, whenever there's a new Chinese investment in manufacturing in Ethiopia, it becomes the headlines. The fact is that manufacturing sector remains very, very tiny in Ethiopia, and it's barely keeping up with overall the economy. So it's not what's driving Ethiopian growth at all. I think what's happening in those countries is more of a pattern of demand-led growth, which, however, because of the structural dualism of these countries, that even periods of demand-led growth can produce an endogenous productivity response, but however, that is not sustainable. So it would take, another half an hour for me to lay out the full story there, which I'm sure you'll be glad I won't take the time to do. But I'll give you the one-slide version of that story, which goes something like this. That imagine that there is an increase in investment demand. So, for example, in the case of Ethiopia, we see this in terms of a very rapid ramp up in public investment. So I mentioned in Ethiopia, agricultural productivity increase. What lies behind the productivity increase in agriculture is actually a big ramp up in public investment in fertilizer, in provision, in power, in roads, in irrigation, that has enabled this increase in agricultural productivity. So there's a big increase in public investment, which I guess on the second panel you can see the total investment is mostly driven by increase in public investment. So what that increase in investment demand does is, first, of course, it has a kind of a direct effect on the overall productivity of the economy. That's the standard conditional convergence, which I've already told you is not going to explain very rapid growth. But the other thing it does is that actually sets into motion a process of structural change, which shows up as increased economy-wide productivity. And that's because the investment demand, as incomes increase, people at the margin demand more services, more modern services in particular. That's the induced structural change. That because the modern services in urban areas have higher productivity than traditional agriculture, that shows up as growth, productivity, increasing structural change, now with the expansion of modern services, though not manufacturing. However, because this productivity change is driven by the initial gap in productivity between modern services and the rest of the economy, it's not sustainable, because as modern services increase output, there is in fact lower and lower productivity inputs are being drawn into those services. And in fact, we have a process of lagging productivity in these expanding services. So what you see in cases like Tanzania and similar countries is that these modern sectors, these modern services, which ought to be increasing productivity, in fact are experiencing relative declines in productivity as they're expanding through this demand channel, which is why I think this kind of growth pattern is not sustainable. So let me just conclude with sort of wrapping up. So because these East Asian style growth miracles were so critically linked with this process of rapid industrialization, I believe that these are not going to be replicated. That has the implication that growth in low and middle income countries has been unsustainably high in the last decade, so I think there's going to be some correction. That doesn't mean that we need to be very pessimistic about growth. I think convergence, there's a very good chance that convergence can continue, partly because the advanced countries will in fact probably not grow as rapidly as they did in the past, but also because on the whole, I would say that the quality of macro fundamentals in the low and middle income countries is much better than it has been in the past. And that means the macro framework, institutions, that's not going to give you a growth miracle, but even if it gives you growth rates of 2 or 3% per annum on a sustained basis, that's still not a bad growth for the medium to long term. However, what I think the critical adjustment that will need to happen is, I think, for policymakers to internalize the lesson of this, which is that that it's going to be that sustainable growth rates are significantly lower than what they've experienced in the past. That's going to create significant challenges for jobs, for employment creation, especially in sub-Saharan Africa, where there's still a youth bulge of significant proportions. And that fundamentally we're going to be in a different kind of world as insofar as growth dynamics are concerned as we go forward. So let me just stop here and thank you for listening. I don't know if there are any questions or.
Okay, thank you very much.
Yeah.
Thank you very much, Professor Rodrik. So we'll now take questions from the floor. You have a question?
Thank you very much, Professor. My question relates actually to the environmental challenges that we are seeing nowadays. So it's mainly two sections. The first one, we're talking about the industrialization. Can we hope for like the emerging countries or the under-industrialized to maybe develop a new type of industrialization that is much more sustainable? The second one would be is that we see more demand worldwide, be it in developing, developed, Western or Eastern countries for ethical products and environmentally ethical, friendly products. So this could probably lead, in what sense, to the development and the new form of industrialization of the under-industrialized countries?
Yeah, I mean, I think the whole climate change challenge and the role of green technologies is a kind of a mixed implication, I think, for developing countries. On the one hand, if you wanted to focus on the climate, you would say, well, maybe, the positive aspect of what seems to be a negative message is, it's going to be good for the environment. That if industrialization is not very good for the environment. I mean, we have climate change is the result of a long sort of everything about industrialization since the Industrial Revolution, and so if this is going to be a smaller and smaller part of the overall picture, some of the challenges for the climate will be less. If you put the emphasis on sort of growth possibilities, then you say the fact that any industry or any economic activity that you're going to now get will have to be cleaner than before, that you have to rely more on green technologies. Does that make growth more or less likely for your economy? I think everything else being the same, I think it probably makes it harder because it makes much greater demands on complementary capabilities and technologies that are not necessarily in line with developing country comparative advantages. So on the one hand, it's good because now it's going to have a lot of cleaner technologies, but those cleaner technologies are much more likely to be available and cheaper in the advanced world than in the developing world. So that's, I think that's, a sense in which it's a mixed picture.
Thank you very much, Professor. I have three questions. The first one is, so you demonstrated that growth miracles were in the second half of the 20th century, and now they are disappearing, partly because many industries are linked to equipment, and society's absorption or economy's absorption of equipment is logarithmic. I mean, we can't buy cars and equipment material indefinitely. So you also stated that productivity gains are less likely in the service industry. Don't you think with the new technologies like artificial intelligence, for instance, productivity gains are still possible if we take an industry or a service company like Amazon? Now, if you enter some of their places or like logistic surfaces, you may find very few employees. Or, for instance, if you consider the job of a trader as a productive job, nowadays, if you go to stock exchanges, you've got less and less traders and more AI robots doing trading by themselves. So we could say that this engineer that programmed these robots made large productivity gains because it saved the bank's jobs of many traders that cost millions of dollars. So this is the first one. The second one is, you said that highly skilled manufacturers are more and more highly skilled. So we didn't see any link or correlation with education because once you state that because we're moving to services, low-skilled population is less likely to work there, low labor. But what about if they were educated? So the third one is a little bit more philosophical. Is growth sustainable? I mean, do we need growth? Because, for instance, if we take agricultural industry, nowadays we produce what can feed 12 billion people. And we are only 7 or 8 billions, and still 1 billion people do not eat like enough. Let's say things like this. So we're more in an issue, I mean, more people die of obesity than of low nutrition. So do we need to grow, or do we need a better allocation of resources? Like nowadays, the most growing companies like Uber or Airbnb, etc., they don't produce. They just reallocate assets that are already produced. So population is decreasing, so job demand would be decreasing. So do we need growth, and is it sustainable? Thank you very much.
Thank you. 3 questions that would take me a very long time to fully do justice to, but let me just go very quickly in reverse order. Do we need growth? I think that's a question that I think one can, reasonably debate in the context of advanced countries, but I think just as a mathematical fact that for low and also middle-income countries, it's very hard to imagine improvements in not just only material living conditions, but improvements in sort of life chances for the bulk of the population to be possible without growth in those countries. So the answer, unambiguously, I think for low and middle income countries is that you cannot improve life chances for the majority of the people there simply by redistributing income. So just that, I usually open my development economics class at Harvard by asking students the question, would you rather be poor in a rich country or rich in a poor country? And almost always people get this answer wrong. I have to tell you, of course, what I mean by rich and poor, but suppose rich and poor denote the top 5%. Somebody who's rich in a poor country is top 5%, or somebody rich, poor in a country is in the bottom 5%. And similarly with their country ranking of incomes, a rich country is country that's ranked in among the top 5% in average per capita income. So the answer for that, it turns out that even though most people think that there is enough resources you can redistribute in low-income countries, so you can say it's much better to be rich in a poor country, that actually, there's like a difference of order of, 3 or 4-fold difference, that being poor in a rich country is much better than being rich in a poor country. And what that really is pointing to is the fact that it's really, you can't do redistribution in the poor countries and just get them up to the levels. And so that's mathematically not possible. On the skills and human capital, absolutely invest in skills, but let's not be naive about that. I think the education is always the answer for the future. It doesn't help your current labor force. And also, there's always a question about whether education is keeping up with the technology. So you need not just education, you need education that's catching up with the demands of technology. And so I think there's a realization that this kind of sort of emphasis on human capital and education as the solution to many of these problems is at the very least inadequate. Certainly it's not going to be the solution to the current labor force. Now the issue about AI, the new digital technologies and employment and so forth. So I think there are several effects there. There's one effect, of course, to the extent that there is a general purpose technological change that reduces costs across the board, then developing countries are beneficiary to that as well. But they're beneficiaries mainly as consumers, because now you have access to technologies that you didn't have access to. And the clearest example of that in the developing world is the mobile telephony. That's been a huge gain from a consumption standpoint. It hasn't had a big impact on the production side, though. But if you think about growth as really being driven on the supply side, and the question is always going to be, where are the productive jobs going to come from? And the problem with all these new digital technologies and artificial intelligence is precisely the problem I mentioned in a much more aggravated form, which is that these are technologies that make demands which are at much greater distance with the underlying comparative advantage of the developing world. So if you look at it from a trade theorist standpoint, it implies a long-term deterioration in these countries' terms of trade, and therefore declining real standards. If you look at it just purely from a growth standpoint, in terms of what's going to drive growth, you have the problem of, why would anybody, where will the productive jobs in these developing countries actually come from? After all, to enjoy the benefits of Amazon and Uber or mobile telephony, you need to have a good productive job that's paying you high wage. And the challenge, the dilemma that these technologies poses is it's no longer evident where these productive high wage jobs is going to come from in the developing countries, let alone the advanced countries. So that's the fundamental issue, I think.
Thank you very much. My name is Mubarak from Senegal. Well, I should say I disagree with the main conclusion. I work for government, so I cannot agree. And, in the 60s, there was also some prediction on Asia, and I think what happened later on shows that the prediction was not right. I will invite you to come to Senegal, so we'll visit the country and maybe neighboring countries. I am sure the next decade you will be very surprised. All our countries, the growth rate will be close to what you are calling a miracle, growth miracle, 4.5% per hit. In fact, for our country, we are targeting 9% for the next 4 years, not 7%, 9%. So if you reduce demographic growth, it will be 6.5%. And if you take the African Union agenda, till 63, the vision is to have 7% in average in all African countries. And I can assure you also, we used to have this industrialization. In fact, if you rigorously, industrialization has not started in Africa yet. So there will be reindustrialization, if you want, or acceleration of industrialization. And it's happening. If you take China, because we are in real economy, we are always discussing with investors. I met some investors from Taiwan. They say we are thinking of going to Vietnam, but there is no land. And it's already crowded. So we are seeking other countries where to go. So the Taiwanese will come, the Chinese will come, all companies. And believe me, manufacturing using non-skilled workers will last at least for the next 30 to 40 years. And by these 40 years, the developing country will reach a certain level of development. So I'm sure that all African countries by 2040 will become high middle-income countries, not low middle-income countries. So I really, and there is a huge potential in agriculture to develop productivity. There is a huge potential in industry to transform the resource coming from the agriculture, from the mining. The transformation is sometimes 5%. Mining may be even 0%. Petroleum, oil, gas. Imagine when you transform all this. Necessarily, industry and growth will increase. So I just want to tell you, I totally disagree with the main conclusion. And I will invite you to Senegal to demonstrate what I am telling. Thank you.
Well, I totally hope you're right and I'm wrong. It's the whole conversation on Africa has really changed in an amazingly and positive way. And I remember, 2 decades ago when I was talking to African business people and governance leaders, and it was the roles were completely reversed. Sort of with me trying to argue look, if you can really grow much more rapidly by doing a few things right, and then, typically hearing a long list of constraints as to why, in fact, Africa is stuck with sort of very low growth. And the best thing that has happened in Africa is this environment of optimism. And it's not just government officials like you. It's really quite striking how business community and African entrepreneurs are very hopeful. And I really hope that you're right and I'm wrong. I do think that there is many countries in Africa, you're right, are starting out from very low levels of industrialization. And so there is some room for increased industrialization. But let's remember a couple of things. First, many of these countries actually had industrialized in the 60s and 70s and deindustrialized under the so-called structural adjustment programs and so forth. So it's not like they're starting with industry for the first time. That they had, many of them are starting with much lower levels of manufacturing that they had before. The second is, sort of where I really would urge some caution is this idea that you're going to be creating lots of jobs for low-skilled workers in places like Senegal, where I really think those jobs are going to be critical. I just don't think they're going to come from manufacturing. So even if you're able to attract a lot of Chinese and other investment, even if you're going to double your manufacturing from about 5% of GDP to 10%, which is not inconceivable, I don't think manufacturing is where the jobs are going to come from. And that really is, if you don't worry about anything, I think I would say worry about where the jobs for the African youth are going to come from.
Yeah, thank you, Professor, for the presentation. I have one question.
Oh, sorry.
I'm here.
Oh, okay.
Okay. I have one question. You, in your presentation, you show that the main path for development, for the growth, is industrialization, and services, they can't do the same thing. But my question is, you was talking about India, even they have a high level of services in IT and something like this, but if we take in consideration what happened now in the world about the digital transformation, I think one of the problem of the services in the past was that services you can't exchange it, they are not tradable. But now, if we look about what digitalization can offer to some economies, we can exchange the services. For example, we've seen there is some platform to exchange services in health, in many other sectors. Maybe it's an important change if this can't give the possibility to think out of the box, and maybe services will be the drive of the miracle of the growth in the next decade or 14 years, the next 14 years, than industrialization in the past. Thanks.
Yeah, again, I wish that were right, but the experience of the advanced world is very disconcerting here, which is that with a much more educated, much more skilled workforce, you're still not generating enough jobs for what in the advanced world would be called sort of the middle class or sort of. So the problem with this digital revolution and these new technologies is that you have to look at it, if you're looking at it from the perspective of growth, you have to look at it from the supply side. You have to look at the question, what are the possibilities for developing countries in their role as providers, producers of these services? Are they being advantaged or are they disadvantaged? Number one point I've made is because these services are much more demanding in skills and basic competence, including institutions, the whole regulatory environment, that immediately compared to older industries puts developing world as a disadvantage from a traditional comparative advantage standpoint. So if you look at it from the standpoint of the global economy and the division of labor, that disadvantages the developing world. Secondly, from the standpoint of what I think is going to be increasingly important in low-income countries, especially in sub-Saharan Africa, is the question of the jobs, which I keep coming back to. So the manufacturing miracles were miracles because they also created jobs for some of the least skilled individuals in the economy. So, these new industries, the digital technologies, from everything that we know, are aggravating that problem, even in the advanced countries, let alone the developing countries where, in fact, the skills gap and the skills disadvantage and the endowment of unskilled labor are so much greater. So I think these technologies are great from the consumption side, but I really am struggling to put together a coherent story about how they would benefit developing countries on the supply and labor market sides.
Oh, okay, thank you very much, and thank you for coming to this conference. So my question is about China and the US-China trade war. With China getting bigger by the day and becoming more competitive, and the shift in the long-term demand from goods to services, can we, African, particularly sub-Saharan African countries, still look at the international, access to international markets as a viable source of sustainable growth? That's my question. Yeah.
I mean, there's no benefit in cutting yourself off from the world market. I think but I think much of what's going to matter to underlying economic fundamentals and employment and overall economy-wide productivity growth in Africa, as in I think the rest of the world, will be determined by what happens domestically. So, and I think all the trends, including these technological trends, which imply that not only that global value chains are less and less employment creating in the developing world, that also global value chains are now being reshored, being brought back to the advanced countries precisely because of this loss of comparative advantage in the developing world. All of that suggests that the marginal contribution of the global economy to growth and development prospects in the low-income countries is going to decline over time. So let me say that again, the marginal contribution of the world economy to growth prospects in the developing world is going to decline. Now, that doesn't mean that that contribution isn't positive and that, therefore, you ought to maintain policies that suggest, that encourage a kind of an intelligent integration into the world economy. But it just means that you don't want to look at globalization as your growth strategy. You want to look at a domestic investment and structural change as your growth strategy.
I would like to thank you very much for your presentation. I'd like to thank the audience for the interest and the questions. So now we will go for lunch and then we reconvene at 1 o'clock.